There's a number so large it defies comprehension. $600 trillion. That's more than 12 times the entire global economy. More than every stock market, every bond, every piece of real estate on planet Earth combined. And it's sitting in the shadows of the financial system like a coiled spring, waiting to unleash chaos that could make 2008 look like a warm-up act. This isn't money in the traditional sense. It's not sitting in bank vaults or investment accounts. It's the notional value of the global derivatives market. A web of financial contracts so complex, so interconnected, that even the people who created it don't fully understand what happens when it breaks. And here's what should keep you awake at night. The cracks are already showing. The timeline is accelerating. And 2026 could be the year it all comes apart. I'm going to show you exactly what this $600 trillion time bomb is, why it's more dangerous than anything we've seen before, and why the smart money is already positioning for the explosion. This isn't conspiracy theory. This is mathematics. Cold, hard numbers that reveal a financial system built on foundations of sand. Before we dive into the mechanics of how this could destroy everything, you need to understand what derivatives actually are. Because most people have no idea they're living inside the largest casino ever constructed. A casino where the house always wins until the day it doesn't. And on that day, everyone loses. Derivatives are financial contracts whose value depends on something else. An underlying asset, an interest rate, a currency exchange rate, even the weather. Think of them as bets on top of bets on top of bets. If a stock is worth $100, you can buy a derivative that pays off if the stock goes up. You can buy another derivative that pays off if the stock goes down. You can buy derivatives on those derivatives, and derivatives on those derivatives, layer upon layer until the original stock becomes irrelevant compared to the mountain of bets built on top of it. The most dangerous type is called a credit default swap. It's essentially insurance on debt. If a company or government defaults on their bonds, the credit default swap pays out. Sounds reasonable, right? Here's the problem. You don't need to own the bonds to buy the insurance. It's like buying fire insurance on your neighbour's house, then your neighbour's house, then every house in the city. And when those houses start burning, you collect on every policy. In 2008, one company alone, AIG, had written so many credit default swaps that when the housing market collapsed, they owed more money than existed in their entire company. They needed $180 billion in taxpayer bailouts to avoid taking down the entire financial system with them. That was 15 years ago. The derivatives market today is 3 times larger. But size isn't the only problem. It's the structure, the interconnectedness, the way these contracts link every major financial institution on the planet into one giant, fragile network. When one node fails, the failure cascades through the system faster than regulators can respond, faster than central banks can print money, faster than governments can organize bailouts. Here's how the cascade works. Bank A owes Bank B $10 billion in derivatives contracts. Bank B owes Bank C $15 billion. Bank C owes Bank A $20 billion. Everything looks fine on paper because the net exposure seems manageable. But when Bank A can't pay Bank B can't pay Bank C. And when Bank C can't pay Bank A, the circle breaks. Not just for these 3 banks, but for every institution connected to them. And in the derivatives market, every major institution is connected to every other major institution. The regulators know this. They've known it since 2008. Their solution was to create central clearinghouses. Instead of banks dealing directly with each other, they would all trade through a middleman. The clearinghouse would guarantee the trades, collect margin payments, and supposedly eliminate the risk of cascade failures. It sounded brilliant in theory. In practice, they just moved the risk from a distributed network to a few concentrated points of failure. Today, just a handful of clearinghouses process the majority of global derivatives trades. They've become the most systemically important institutions on the planet. More important than any individual bank. Because if a clearinghouse fails, it doesn't just affect its members. It freezes the entire derivatives market. And a frozen derivatives market means frozen credit markets, frozen currency markets, frozen everything. The clearinghouses work on a simple principle. They collect margin payments from traders to cover potential losses. When markets move against a position, they demand more margin. If traders can't pay, they liquidate the positions. The system works perfectly until it doesn't. Until margin calls spike so fast and so high that even large institutions can't keep up. until liquidating positions drives prices further against the remaining positions, creating a death spiral that no amount of margin can stop. This is called procyclicality. When markets are calm, the system amplifies the calm. When markets panic, the system amplifies the panic. The clearinghouses that were supposed to be circuit breakers become accelerants, pouring gasoline on fires instead of water. And here's the terrifying part. The people running this system, the handful of executives at the major clearinghouses and the largest derivatives dealers, they know exactly what they've built. They understand the mathematics of cascade failure. They've run the stress tests. They know that under certain conditions, the system will collapse faster than any intervention can stop it. But they keep operating because the profits are too large, and the alternative, admitting the system is fundamentally broken, would trigger the very collapse they're trying to avoid. So they maintain the fiction that everything is under control. They publish risk reports showing manageable exposures. They testify before Congress that the system is safer than ever. They collect their bonuses and hope that when the music stops, they'll be far enough away from the explosion to survive it. The music is about to stop, not because of some unpredictable black swan event, but because of a predictable convergence of regulatory deadlines, market pressures, and mathematical inevitabilities that are all pointing toward 2026. The regulatory piece is critical because it's creating forced changes in how derivatives are calculated, traded, and reported. The Basel III framework, which governs banking regulations globally, includes new rules for derivatives trading that banks must implement by 2026. These aren't minor adjustments. They're fundamental changes to how institutions calculate their capital requirements, manage their risk, and conduct their business. But here's the problem. Different countries are implementing these rules on different timelines. The United States is pushing for mid-2025 compliance. The European Union has delayed until 2026. The United Kingdom has pushed back to 2027. This creates regulatory arbitrage, where institutions shop around for the most favourable jurisdiction. It also creates coordination problems, where institutions operating across multiple jurisdictions must comply with multiple sets of rules that may conflict with each other. The technical implementation is even more challenging. Banks need new data systems, new risk models, new reporting mechanisms. They need to hire thousands of compliance specialists and technology experts. They need to restructure their trading operations and potentially exit certain markets entirely. All of this must be completed under compressed timelines, with regulators watching every move. The smart institutions started preparing years ago. They've been quietly reducing their derivatives exposures, upgrading their systems, and positioning themselves to survive the transition. The unprepared institutions, the ones that waited until the last minute, are about to discover that 2026 isn't just a regulatory deadline. It's a survival test, and many of them are going to fail. The failure won't be random. It will follow a predictable pattern that regulators have been tracking but can't publicly acknowledge. When institutions can't meet the new capital requirements, they'll be forced to sell derivatives positions. Not gradually, not strategically, but all at once. Fire sales that will drive prices in directions no one expects. Here's what makes this different from 2008. Back then, the crisis started in one sector, housing, and spread outward. The derivatives collapse of 2026 will start everywhere simultaneously. Interest rate swaps worth $393 trillion, currency derivatives, commodity futures, credit default swaps, all of them interconnected through mathematical relationships that seemed brilliant when markets were calm but become death traps when markets turn violent. The mathematics are unforgiving. When you build a system where every participant owes money to every other participant, you create what economists call systemic fragility. Small shocks get amplified, medium shocks become catastrophic, and large shocks, the kind that happen maybe once every few decades, they destroy everything. The shock that triggers the 2026 collapse won't be a housing bubble or a tech crash. It will be something much more fundamental, a sovereign debt crisis. When a major government can't pay its bills, the credit default swaps written on that government's debt suddenly become very expensive. The institutions that sold those swaps, thinking they were collecting free money on an impossible event, will face losses that dwarf their entire capital base. Which government? The mathematics suggest it could be any of the major economies. The United States owes $37 trillion and pays more in interest than it spends on defense. Japan's debt-to-GDP ratio exceeds 250%. European governments are struggling with energy costs and demographic transitions. China's local governments owe trillions in hidden debt through off-balance sheet financing vehicles. Pick your poison. When the sovereign crisis hits, it won't just affect government bonds. It will cascade through every asset class because modern portfolio theory assumes that government bonds are risk-free. When that assumption breaks, every model breaks. Every risk calculation becomes invalid. Every hedge becomes a source of additional loss instead of protection. The central banks will try to intervene. They'll cut interest rates to zero. They'll print money. They'll buy bonds directly from governments. But derivatives aren't like stocks or bonds. You can't just create more of them. When a credit default swap pays out, someone has to pay. When an interest rate swap moves against you, someone has to post margin. Real money, not printed money. Money that exists in bank accounts and can be transferred immediately. The Federal Reserve learned this lesson in 2008 when they had to bail out AIG. It wasn't enough to promise liquidity. They had to provide $180 billion in actual cash because AIG's counterparties demanded immediate payment. Today's derivatives market is 3 times larger. The potential cash requirements are 3 times larger. And the Federal Reserve's balance sheet, while bigger than in 2008, isn't big enough to handle a full-scale derivatives meltdown. The European Central Bank faces even worse constraints. They can't just print euros to bail out individual banks without approval from multiple governments. The approval process takes weeks. Derivatives markets move in minutes. By the time European officials finish their meetings, the cascade will have consumed half the continent's banking system. The Bank of Japan and the People's Bank of China have their own problems. Japan's entire economy is built on cheap money and stable debt markets. If derivatives markets freeze, Japanese banks lose access to the funding they need to operate. China's banking system is opaque even to Chinese regulators. When derivatives positions start unwinding, no one will know which Chinese institutions are solvent and which are zombies propped up by government guarantees. This creates a coordination nightmare. Central banks that need to work together to stop a global crisis won't be able to communicate fast enough or act decisively enough. They'll be fighting the last war, using tools designed for traditional banking crises against a derivatives-driven meltdown that follows completely different rules. The private sector won't be much help either. The major investment banks, the ones with the largest derivatives portfolios, will be fighting for their own survival. They won't have spare capital to support failing institutions or provide market liquidity. They'll be selling everything they can sell and hoarding everything they can hoard. BlackRock, Vanguard, and State Street, the 3 asset management giants that control $20 trillion in investments, will face a different problem. Their funds own derivatives indirectly through the banks and hedge funds they invest in. When those underlying investments collapse, the funds collapse. Pension funds, insurance companies, sovereign wealth funds, all of them will watch their portfolios evaporate in real time. The speed of the collapse will be unprecedented. In 1929, the stock market crash took weeks to fully unfold. In 2008, the crisis played out over months. The derivatives collapse of 2026 will happen in days, maybe hours. Algorithmic trading will accelerate every move. Social media will amplify every panic. Digital banking will enable instant withdrawals that drain institutions faster than regulators can respond. The only institutions positioned to survive will be the ones that prepared in advance. The banks that reduced their derivatives exposures over the past few years. The hedge funds that built up cash reserves and avoided complex structured products. The family offices that moved money out of financial assets and into physical assets. Land, commodities, things that exist independently of the banking system. The preparation isn't secret. If you know where to look, you can see it happening. Major banks have been quietly closing derivatives trading desks. Hedge funds have been raising cash and reducing leverage. Wealthy individuals have been buying farmland, precious metals, and Bitcoin. Not because they're pessimists, but because they understand the mathematics of what's coming. The derivatives time bomb isn't a possibility anymore. It's a certainty. The only questions are exactly when it explodes, which institution lights the fuse, and how far the damage spreads. The mathematical models all point to the same conclusion. The system is too leveraged, too interconnected, too complex to survive the stresses building toward 2026 D2026. The institutions that recognize this mathematical reality aren't waiting for official warnings. They're repositioning now before the crowd understands what's happening. Because when $600 trillion in derivatives contracts start unwinding simultaneously, there won't be time for gradual adjustments or strategic repositioning. There will only be survivors and casualties. The credit default swap market represents the most concentrated risk within this larger catastrophe. Current data shows $38 trillion in total CDS activity, with single-name credit default swaps reaching their highest levels since the financial crisis. Portfolio managers are selling protection at an unprecedented pace, collecting premiums while betting that defaults won't happen. They're essentially writing insurance policies on corporate debt while assuming the companies will never fail. This isn't stupidity, it's incentive structure. Fund managers get paid based on quarterly returns. Selling credit protection generates immediate income that boosts performance numbers. The potential losses from widespread defaults won't materialize for months or years. By then, the managers will have collected their bonuses and moved to different firms. The losses will belong to pension funds, insurance companies, and individual investors who trusted the system. The concentration of risk makes this even more dangerous. Just 13 counterparties handle daily single-name credit default swap trading on European banks. 13 institutions control the insurance market for some of the world's largest financial companies. When those banks start showing stress, these 13 institutions will face simultaneous margin calls that could exceed their entire capital base. Compare this to the broader index CDS market, where 160 counterparties provide some distribution of risk, but even there, the exposure is becoming dangerously concentrated. US institutions hold over $100 billion in investment-grade credit default swap positions, the highest level in 3 years. They're betting that corporate America will remain healthy, just as corporate debt reaches record levels and interest rates make refinancing increasingly expensive. The regulatory framework compounds these risks instead of managing them. Current Basel III rules treat insurance buyers and sellers equally, even though sellers face unlimited potential losses, while buyers risk only their premium payments. The regulations don't require institutions to investigate correlations between their internal risks. Most critically, they don't charge institutions for externalizing systemic risk or marketing conflicted products to unsophisticated investors. This creates moral hazard on a global scale. Institutions can write unlimited credit default swaps, collect immediate profits, and transfer the systemic risk to taxpayers who will fund the inevitable bailouts. The profits are private, the losses are socialized, and the system grows larger and more fragile with each quarterly earnings cycle. The European Union has attempted to address some of these issues by requiring more derivatives trades to go through central clearinghouses. But this creates the same problem we discussed earlier. Risk isn't eliminated, it's concentrated in clearinghouses that become single points of failure for the entire system. When a clearinghouse faces margin calls it can't meet, it doesn't just fail, it takes down every institution connected to it. The cross-border complications make this worse. Credit default swaps referencing European entities can be traded entirely between non-European counterparties outside European regulatory oversight. American regulators can't monitor European risks. European regulators can't monitor American risks. Chinese regulators operate in complete opacity. When the crisis hits, no single authority will have enough information to coordinate an effective response. The implementation timeline for new regulations adds another layer of instability. The fundamental review of the trading book requires banks to completely restructure how they calculate market risk. Some countries have implemented these rules, others are delaying until 2025 or 2026. This creates regulatory arbitrage where institutions move risky trades to jurisdictions with more favorable rules. Banks operating across multiple jurisdictions face impossible choices: comply with the strictest regulations and lose competitive advantage, or comply with the weakest regulations and face penalties in stricter jurisdictions. Many are choosing a third option, reducing their derivatives activities entirely. This withdrawal of major market makers is reducing liquidity precisely when markets need it most. The data requirements alone are staggering. Banks need to track every derivatives position in real time, calculate risk correlations across thousands of instruments, and report everything to multiple regulators using different formats and standards. The technology infrastructure to support this doesn't exist at most institutions. They're building it while trying to comply with deadlines that don't allow for testing or gradual implementation. The human capital requirements are equally challenging. Banks need thousands of compliance specialists who understand both derivatives, mathematics, and regulatory requirements across multiple jurisdictions. These specialists don't exist in sufficient numbers. Universities don't teach the necessary skills. The few experts who exist are commanding enormous salaries and moving between institutions, taking their knowledge with them. This creates operational risk that could trigger the derivatives collapse independently of market movements. When banks can't calculate their positions accurately, they can't manage their risks effectively. When they can't report their positions to regulators, they face penalties and restrictions. When their systems fail during periods of market stress, they can't execute the trades necessary to manage their exposures. The algorithmic trading systems that dominate modern derivatives markets aren't designed for this type of regulatory uncertainty. They assume stable rules, reliable data, and predictable counterparty behavior. When any of these assumptions break, the algorithms can amplify volatility instead of providing liquidity. Flash crashes that last minutes in normal times could persist for hours during regulatory transitions. The interconnections between derivatives markets and traditional banking create additional vulnerabilities. Interest rate swaps worth $393 trillion determine borrowing costs for mortgages, corporate loans, and government debt. When swap markets freeze, credit markets freeze. When credit markets freeze, the real economy stops functioning. Currency derivatives markets face similar risks. International trade depends on companies being able to hedge foreign exchange exposure. When currency derivatives markets become unreliable, companies stop engaging in international transactions. Global supply chains that took decades to build can unravel in weeks when the financial infrastructure supporting them collapses. Commodity derivatives markets present their own systemic risks. Food producers hedge crop prices months in advance. Energy companies hedge oil and gas prices. When these hedging markets fail, commodity prices become wildly volatile. Food shortages and energy crises can emerge not from physical supply problems, but from financial market dysfunction. The pension fund industry represents one of the largest concentrations of derivatives risk. Public employee retirement systems, corporate pension plans, and individual retirement accounts hold trillions of dollars in derivatives indirectly through their investments in banks, hedge funds, and structured products. When these underlying investments collapse, retirees face losses that no government program can offset. Insurance companies face dual exposure. They use derivatives to hedge their own risks while simultaneously providing insurance to other institutions using derivatives. When derivatives markets collapse, insurance companies lose money on their hedges and face massive claims from their policyholders. The industry that's supposed to provide stability during crises becomes another source of instability. The wealth concentration in modern financial markets makes this even more dangerous. 3 asset management firms control over $20 trillion in investments. Their decisions move entire markets. When they're forced to liquidate positions to meet redemptions, they can trigger cascading failures across multiple asset classes simultaneously. These firms aren't deliberately creating systemic risk. They're responding to the incentives created by the financial system. But their size means that their individual decisions have systemic consequences. When they buy, prices rise across the board. When they sell, prices fall everywhere. This procyclical behavior amplifies both booms and busts. The shadow banking system, which includes hedge funds, private equity firms, and other non-bank financial institutions, holds enormous derivatives positions that aren't subject to traditional banking regulations. These institutions can take risks that banks can't take, but they're also more fragile when markets turn against them. Their failures don't just affect their investors. They affect every institution connected to them through derivatives contracts. The global nature of modern derivatives markets means that a crisis starting anywhere can spread everywhere within hours. Time zones provide no protection when electronic trading operates 24 hours a day. Geographic diversification provides no protection when all markets are connected through mathematical relationships. The $600 trillion derivatives time bomb isn't waiting for permission to explode. The mathematical certainties, regulatory deadlines, and institutional vulnerabilities are converging toward 2026 with the precision of a Swiss watch. The smart money has already seen the calculations and made their moves. The only question left is whether you'll be positioned among the survivors or counted among the casualties when the largest financial explosion in human history finally detonates.